Imagine working at a company worth over $100 billion, only to discover that the entire business was built on lies. Employees lost their jobs, investors lost billions, and one of America's biggest companies collapsed almost overnight. This is the story of Enron. In the 1990s, Enron was considered one of the most innovative companies in America. The company was based in Texas and originally focused on natural gas and energy trading. But Enron wanted to become much bigger. Under CEO Jeffrey Skilling and founder Kenneth Lay, the company expanded rapidly and became a Wall Street favorite. Investors loved Enron. The media praised Enron. And employees believed they were working for the future of American business. At its peak, Enron was worth more than $100 billion. But behind the success, something dangerous was happening. The company was secretly manipulating its financial reports to appear far more profitable than it actually was. One of the main tricks Enron used was called mark-to-market accounting. Normally, companies report profits only after they actually earn money. But Enron used a different method. If the company signed a contract expected to make money over the next 10 years, Enron immediately counted all of those future profits as current income, even if the money never arrived. This allowed the company to report huge profits on paper while hiding major losses in reality. But that was only the beginning. Enron also created complex shell companies to hide billions of dollars in debt from investors and regulators. These hidden companies allowed Enron to move bad assets and financial losses away from public reports. To the outside world, Enron looked extremely successful. Inside the company, however, the financial situation was becoming a disaster. Executives continued encouraging employees and investors to buy Enron stock while secretly knowing the company was in serious trouble. Then the warning signs started appearing. In 2001, Enron employee Sharon Watkins sent a warning letter to company leadership. She warned that Enron could collapse in a massive accounting scandal. But the problems were already too large to hide. Soon, journalists and financial analysts began investigating the company. As the truth slowly became public, investors panicked. Enron's stock price crashed dramatically. The company's shares fell from more than $90 to less than $1 within months. Thousands of employees lost their jobs. Many workers also lost their retirement savings because their retirement accounts were heavily invested in Enron stock. Families lost life savings almost overnight. In December 2001, Enron officially filed for bankruptcy. At the time, it was one of the largest corporate bankruptcies in American history. The scandal also destroyed Arthur Andersen, one of the world's biggest accounting firms. The company had helped Enron hide financial problems and was later found guilty of obstructing investigations. The collapse of Enron shocked the entire business world. It exposed major weaknesses in corporate accounting and financial oversight in the United States. As a result, the U.S. government introduced new laws to strengthen corporate transparency and protect investors. One of the most important reforms was the Sarbanes-Oxley Act, passed in 2002. The law increased financial reporting requirements and created stricter penalties for corporate fraud. Today, Enron is remembered as one of the biggest corporate scandals in history. A company once praised as the future of American business turned out to be built on deception, greed, and false promises. And when the truth finally came out, the entire empire collapsed. Imagine